Hi team. In this video, I'm going to walk you through the process of projecting the financial statements for an LBO model. This is going to be a quick build, something that will help us think through the transaction that will hopefully take place in 60 to 90 days. To build something quickly, we're going to continue working with the workbook that was provided and adjusting it to meet our needs. The alternative would be to build the template yourself and cut and paste all of the data into that template, which can be very time consuming. But as a word of caution, you have to be very careful working with other people's data. Even if you trust the source, always audit the workbook before getting started. Otherwise, you may find that you've been building on a weak or faulty foundation when you're way too far into the process. As a quick recap, in previous videos, we established a framework for the balance sheet adjustments and then populated that framework with a sources and uses table. I'll include links in the notes below the video player, and just so you know, there are 3 in total. One to build the framework, a second to build the sources and uses table, and finally a third to explain how to populate the framework with the information contained in the sources and uses table. Which means that now our job is to project the 3 financial statements with a balance sheet that has been updated to include the purchase of 100% of the common stock of the target company. That can sound a little abstract, so let's look at what that means. Previously, the founder and CEO of the target company, along with any other shareholders, held 100% of the common stock. Interested in cashing out, the company hired an investment bank to sell the business, and you received some confidential information to review the opportunity. To demonstrate interest in the opportunity, you submitted an indication of interest. And in response, you were invited to submit a letter of intent summarizing the terms under which you would be interested in moving forward. Now, I moved through that a little bit quickly because this process is described in fantastic detail in the lesson titled Securing Exclusivity. And full stop, this is what you're building the model for. To start thinking through valuation, risk, and capital structure. At this stage, your firm is already in due diligence, and once the LOI is executed, you will begin to negotiate the stock purchase agreement, which as an aside is the single most important document in a stock acquisition, which we've also broken down in great detail as part of the private equity training curriculum. Now, with the SPA executed, the buyer will most likely create a new entity, which we will call Holdco. And this entity, post-transaction, now holds the company you set out to acquire, and you control it. But here's the thing, and the purpose for this introduction. Until you make changes to how the company's operated, the only thing that has changed about the company is the capital structure. And this is very important to think about as we work through this exercise. Because aside from this one change, the process of projecting the financial statements is nearly identical to the process of building a 3-statement model. In this video, we will discuss more theory than mechanics, so if you've not watched those videos first, I would recommend it as a suggested prerequisite. So let's look at where we are in the Excel workbook.
And the first thing we will do is rename the tab, Summary Financials 2, to emphasize that this is just a 3-statement model adjusted to reflect a transaction. Let's name it 3SM. So press Alt-HOR and write 3SM. In the historical period, we can look at the grayed out areas to identify what is new. And per the comments made in the introduction, you will note that everything relates to the acquisition and capital structure. We added a line for the tax rate, which will be helpful moving forward. And on the balance sheet, you will see we have line items for the capitalized financing fee, goodwill, and new line items for debt. The business is otherwise the same, and that is how we're going to project it. On the first iteration, I like to project with a highly conservative bias, and I'm mostly focused on making sure it is mechanically sound. Once it's all built, I will come back and really fine-tune the inputs.
But before we get started, we need to make some adjustments to the income statement that are non-GAAP. We are going to remove depreciation from COGS and give depreciation its own line item on the income statement. And here's why. Depreciation is, of course, included in COGS. And as it relates to financial models, you can find both approaches on asimplemodel.com. But the logic for excluding it is as follows. If you are forecasting historical information without contemplating a change to operations, where the intention is to continue along the same growth trajectory and just let management do what they do best, then projecting depreciation as part of COGS generally works. But since LBO strategy frequently contemplates a change in capital structure and strategy, it's likely that CapEx will look different post-transaction. I could expand on this in quite a bit of detail, but it's not the objective of this video, so let's move forward.
We're going to make this change in 4 steps. And here's a cool trick. When you're going to make changes that should not alter certain outcomes, like rearranging line items, pull up the snipping tool and capture the data before any of those changes are made. Now you have a reference for when you're done. So back in the Excel workbook, let's get started with step 1, which is to add rows for EBITDA, depreciation, and amortization. So press Alt-IR and then F4 to repeat the action. Next, press Alt-HOH to change the height of the cell. And we will repeat that for depreciation and amortization. Next, since this income statement pulls from the operating model, input your totals as formulas. Now, recall that we will be pulling depreciation out of COGS momentarily, so EBITDA will be equivalent to gross margin less total SG&A. Press Ctrl-R to paste across. EBIT is then equal to EBITDA minus depreciation and amortization. And finally, we have net income, which is equal to pre-tax income minus tax expense. And you will notice that with the exception of EBITDA in this grayed area, nothing has changed. And the reason EBITDA changes is because we need to move depreciation from row 17 to row 35. So highlight the contents of the cell for depreciation, press Ctrl-C to copy, and then in cell P35, paste the value, press Enter, and then use Ctrl-R to paste across. And of course, delete depreciation above to avoid any double counting. You can press Alt-ED to delete the row. Finally, and this is big, labels. We need to include net of D&A for all the relevant line items. Proper labels are hugely important to a financial model. If you make this change without including net of D&A in all the appropriate places, you're likely to get some questions. As a final step, using the snipping tool, you can confirm that the changes were made without any errors. Using the final year as an example, we have $6,303,954 of net income and $8,842,664 of EBITDA. No need to save this. And with that, we are done updating the income statement for that purpose, which means that now we can get started with the projection. Now here I have the same tab with purple markers on the left-hand side to indicate what's new. But to save us a little time with formatting and inputs, I have the income statement already projected. Before starting with the projection, let's quickly rename the worksheet with Alt-HOR, and we will just call it 3SM Part 2. And next, I will scroll over so that we can zoom in for a closer look. You can use keyboard shortcut Alt-VZ and change the zoom to 150%. Now, we have walked through the process of projecting an income statement many times, so in this video, I'm just going to explain the formulas. Starting with revenue, I'm going to assume that the company cannot maintain this incredible growth. I'll input the management projection in year 1, which you can see on the old Summary Financials worksheet, is 17.5% for the period ending 12/31/2021. And then after that, I'm just using 10% as a placeholder. And the formula for revenue is the prior year multiplied by 1 plus the growth rate for that period. And the reality is that unless the company has established differentiated products that customers cannot get enough of, or benefits from incredible barriers to entry, the competition will catch up. So I am being far more conservative than the history suggests until management and/or research done in due diligence convinces me otherwise. Also, keep in mind that these are all just placeholders for the time being. At the moment, we just want to make sure that the model is mechanically sound. Next, I want to project gross margin, which is the company's profit after producing the product. And you will note that as it's scaled, the company's gross margin has expanded. This is a good sign, but as a conservative measure placeholder, I'm going to project this flat from the most recent period. In other words, I'm not giving the company credit for expanded gross margin under continued growth. Not yet, anyway. So I'm using 29.9%, which is the same as the prior year, and the formula for gross margin is that percentage times revenue. Total COGS is then simply backed out from this number, and we're not going to work with all of this detail in this model. Next, we will project SG&A, and notice how it consistently drops as a percentage of revenue, which means that the company benefits from economies of scale. While we will need to revisit it later, for the time being, we will straight line the most recent historical percentage and temporarily eliminate this advantage. So we have 12.6% across the projected period, the same as the most recent historical period. And the formula for SG&A is this percentage multiplied by revenue. Next, we can calculate EBITDA, because depreciation has been removed from COGS. Depreciation and amortization will be left blank because these figures will pull from supporting schedules, but we can still enter the formula for EBIT, which is just EBITDA less depreciation and amortization. Next, interest expense will also pull from a supporting schedule, so we will leave that blank for now. But note that we are marking all missing items with a red shaded background, as a reminder to revisit these line items in the future so that nothing gets overlooked. Next, you have pre-tax income, which is earnings before interest and taxes less interest expense. And for this quick build, let's ignore franchise tax and just include a federal corporate tax rate of 21%. Which brings us to net income, equivalent to pre-tax income less tax expense. And with that, we are done for the moment with the income statement. And in the next chapter, we will cover the balance sheet. All right, team, that's all for now. Thanks for watching.